So recently I was reading an article which showed the impact that America's central bank, the Fed, has had on people. Specifically, the difference in how they've impacted the richest 10% in the country versus how they've impacted the bottom 90% in the country. So we all know that the wealth gap exists between the richest people in society and everyone else. I mean, you've probably read numerous headlines about how Jeff Bezos has become X amount wealthier over the course of 2020, while many regular people have been losing their jobs. It's no secret that this wealth gap has become a particularly painful point for many people. When the country as a whole seems to be growing so well, it's really no surprise when somebody who's living paycheck to paycheck, they don't feel like the system is fair. But what I find particularly shocking, though, is that when you dig into the numbers, you begin to realize that the wealth gap isn't as a result of a conspiracy, as some might claim, or that the bottom 90% of society don't work hard. I mean, of course they do. It comes as a direct consequence of the design of the core system itself. That's why in this video, we're going to take a look into how the USA's central bank, the Fed, has played their role in increasing the wealth gap and, most importantly, what you can do about it to protect yourself. So on the screen now, you can see two charts and two graphs. Don't worry if they look complex, I'll talk you through them. In the top left, we have the question: are stocks indicating a strong economy? So the red bar chart shows us the growth of the American stock market since 2009, an impressive 203%, while the chart to the right shows us the growth of the economy over the same time horizon, a much lower 22%. On the right hand side, we can see what this looks like plotted on a graph. So we have the economy plotted in blue and the stock market plotted in orange. As we can see, there has been a substantial difference in the growth between the two, with the economy severely lagging behind the stock market. So on a basic level, the economy and the stock market, they should be pretty similar. If the economy is growing, well, that means more people have money in their pockets. More money usually leads to higher spending. And of course, people will spend their money with companies. As a result, the value of companies, i.e. stocks, is going to rise. So of course, the economy and the stock market should be very strongly linked. At the same time, we don't expect them to have a perfect correlation. I mean, among other reasons, the stock market is forward-looking. Investors in the market are trying to predict what is going to happen in the future with companies, whereas the economy is just based on what is happening today. However, even if the stock market and economy are not perfectly linked, how can the market have grown by over 200% while the economy has barely climbed 20%? How can the stock market have grown 10 times more? Well, let's have a look at the central bank's actions, the Fed's actions in that same period of time, and the picture might become clearer. So looking at this bar chart, we can see again the stock market growth. This time, however, we can also see the balance sheet of the Fed. Or another way of saying this is that we can see the amount of money that the Fed has printed and used to buy various assets. As we can see, the value of assets that they hold has grown by over 400%. Now on the right, we can see this plotted against the value of stocks, and the correlation between the two is clearer. Over the course of 2020, the Fed has been heavily scrutinized, and not just because of the amount of money they've printed either, but because of where some of this money has gone. They announced their intentions to loan money directly to companies by purchasing corporate bonds. Even companies like Apple, who have performed extremely well over the course of 2020 and had nearly $200 billion in cash earlier this year, have effectively received loans from the Fed. As a result of this, the stock market has climbed massively from its drop earlier in the year. In fact, at the time of recording, the stock market is above where it was at just the beginning of this year, which is insane when you consider that this chart from the US Bureau of Economic Analysis shows us the percentage change in GDP, i.e. the economy, compared to the previous quarter. And, well, 2020 isn't exactly looking great. And that's the problem that we could see playing out in the charts from earlier. The stock market seems to be more based on the Fed's actions than it is on the economy. I mean, if you think about it for a second, if the market is higher today than it was at the start of this year, that essentially means that either companies are making more money today, which they aren't, investors are more optimistic about future growth today than they were at the start of this year. I don't think many investors are, or the stock market has become dependent on a factor outside of the economy. In this case, that would be the Fed's actions. And we've seen evidence of this as investors eagerly listen to every word that the Fed's chairman, Jerome Powell, says in the hopes that they'll pick up an indication of what the Fed will do next. So what's the big problem here? Well, the problem is that the bottom 90% of society are more influenced by the economy than they are by the stock market. Well, the top 10%, well, let's take a look at who owns the stock market. The top 1% of society, they own 53% of the market. The top 10%, excluding the very top 1%, they own 35%. And the bottom 90% of people own just 12%. Said more clearly, the top 10% of society own 88% of the stock market, while everyone else owns just 12% between them. So while the bottom 90% of society are more affected by the economy, the top 10% are more affected by the stock market. So you can probably see where I'm going with this. Because the economy has been left behind by the stock market over the past 11 years, and particularly so during 2020, this has further extended the wealth gap between the top and bottom in society. Now, I do want to be clear in saying that the Fed printing money, of course, is not the only factor which has caused the wealth gap. I'm also not saying that printing money in the right quantities at the right time is a bad thing either. What I'm saying is that money printing in such aggressive quantities and done at such a rapid pace has, in my opinion, and based on the data that I'm seeing at least, increased the wealth gap at an alarming rate. So what can we do about it? Well, to tell you the truth, it makes me pretty angry. As you'll know, if you're a subscriber, I'm a big fan of Ray Dalio, and he's spoken for some time about how factors like a growing wealth gap are a real concern. And the real answer, the real solution would begin at the top. It would be with the Fed making changes to their approach. I don't know if there are many people out there who would disagree that printing money so aggressively and even distributing some money directly to the hands of companies that don't necessarily need it, they really don't need it in some cases, has a more positive effect on the stock market than it does on the economy. Well, as we know that the top 10% and especially the top 1% hold the vast majority of stocks, well, anything that increases the value of the stock market much more so than the economy is going to increase the wealth gap further. Therefore, I actually kind of find it difficult to know what to say because I think it's just a truly unfair system in many ways. But listen, if we can't change how the game works, there's no point me just ranting on about it to you. Instead, I'll try to give you some practical advice that you can implement. So what we've seen over the course of the last 11 years, and particularly in 2020, is that money can be printed and will be printed in any time of crisis. As a result, in the long term, cash is really not a safe thing to hold. If the supply of cash is increasing, it's only a matter of time before the value of each individual dollar drops. And that's what we've been seeing over the course of this year already, when compared to things that you want to buy and compared even to other currencies that are also being printed. So for me, holding cash is not something that I'm particularly keen to do. But let me qualify this because I don't want there to be any confusion. When I'm speaking negatively about cash, I'm talking about for the long term. Holding cash for, let's say 12 months, for example, is not a problem. As I'm a long-term investor, I'm generally thinking and always talking about longer time horizons. And cash is also essential as part of a 12-month emergency fund. In fact, before you consider investing any cash, the most important thing you can do is build up an account with 12 months worth of expenses in cash. So cash is not universally bad. It's actually pretty good for a short-term hold or as part of a rainy day fund. But it's not something that any top investor will hold much of for many years. When the Fed is devaluing cash, investors will often turn to other stores of value. In this case, the original form of money before money could be printed. Gold. Investors such as Ray Dalio have told us for many years that holding a portion of our portfolios in gold is a wise decision. He said that from many years before these kind of things have been going on. Gold is generally uncorrelated to the stock market, which in modern portfolio theory is a big positive. And I'm going to go out on a limb and say that the Fed showing how easily money can be printed is maybe bullish for an item that used to be money itself just last century and can't be printed. However, you might have seen this chart which shows how gold is at all-time highs and thought to yourself, well, that means now is a bad time. In case you have seen this, let's show you a more accurate chart. This time, we've adjusted for inflation. Now we can see the gold is lower today than it was in 1980. So what I'm going to do is I'm going to link you to a video I've put together which covers Ray Dalio's most recent changes to his portfolio and how much of a role gold plays within it. As one of the best investors over the past 4 decades, he's someone I'm always following closely, and I think you should too, regardless of whether he's having a good or a bad year, as he's proven himself over the course of so many years to be a great investor. So if I've timed it right, that video should be up here now. Let me know your thoughts in the comments. Do the Fed's actions make you nervous long term? Or are you just happy to see the stock market rising regardless of how it's happening? There's no right or wrong answer, so let me know your thoughts below. And of course, thank you for watching.